Imagine buying a property where, you just do not care what the kitchen looks like. You don't
Wow.
care about the quality of the local school district. And if the roof suddenly caves in during a storm, your tenant is legally obligated to pay for the repairs.
Sounds pretty nice, honestly.
Yeah, right. Well, welcome to the cold, calculated machine of commercial real estate. Welcome to today's deep dive.
It really is a machine.
Yeah.
And that presents a fundamental paradigm shift for anyone who's transitioning over from the residential market because, residential investing is inherently emotional.
Oh, totally. It's all about, oh, I love the view for the backyard, or look at the flow of the living room.
Exactly. People get attached. But commercial real estate operates on an entirely different plane. It's strictly about financial metrics, macroeconomic trends, and tenant demand. You aren't acquiring a physical structure. You are acquiring a leveraged income stream.
Right. And today, we're extracting the core business strategies and investment frameworks from Willem Tait's book, Practical Principles of Commercial Real Estate Investment.
It's a fantastic resource.
It really is. So our mission here today is to give you, whether you're, say, a seasoned C-suite executive looking to diversify a portfolio, or just a curious learner wanting to understand wealth mechanics, we want to give you the practical blueprint to read a commercial deal properly.
Which is crucial right now.
Yeah, because the market is shifting so rapidly. Capital is tighter, municipalities are strictly regulating zoning, and technology is just rewriting the map of where people work and shop. It's like playing a high-stakes strategy board game, but somebody just changed all the rules on you overnight.
Yeah, that's a great way to put it. You absolutely cannot rely on yesterday's playbook to survive in this environment.
So let's get into the weeds here. If commercial real estate is all about the numbers, how do we actually measure the pulse of a deal before we put any money on the table?
Well, surviving this market requires a pretty surgical approach to evaluating that income stream before committing capital. And Tait outlines a sequence of foundational metrics that govern this space. It all starts with net operating income, or NOI. NOI.
Right. So NOI is the raw cash-generating power of the property. You calculate it by taking your gross potential income and simply subtracting your operating expenses. It measures the viability of the asset before debt service and before taxes.
Because if a property can't generate a positive NOI on its own, no amount of financial engineering is going to save it, right?
Exactly. You'd essentially just be subsidizing a building's existence out of your own pocket.
Which nobody wants to do.
Right. Which leads directly to how we value that income stream, which is the capitalization rate, or cap rate.
Okay, break that down for me.
Sure. You find it by dividing the NOI by the purchase price. So say an industrial warehouse produces $120,000 in NOI, and the purchase price is $2 million. Your cap rate is 6%.
Got it.
It basically represents the unleveraged yield of a property over 1 year. It acts as a universal metric so you can compare dissimilar assets. Like you can compare the yield of a self-storage facility in Texas against, say, a medical office in Ohio. That makes sense. But Tait also talks about cash-on-cash return, right? How is that different from the cap rate?
Good question. So while cap rate assumes an all-cash purchase, cash-on-cash return measures the annual return on your specific equity investment, factoring in your loan payments. So it tells you exactly how hard your liquid capital is working for you.
Okay, but to generate that baseline NOI in the first place, the property relies entirely on the underlying lease structures, doesn't it? Like the building doesn't just print money.
No, definitely not. The income is completely dictated by the lease agreements.
Right, and Tait goes over a few. The gross lease seems like the easiest one to grasp. The tenant pays a flat, predictable monthly rent, and the landlord covers all the property-related expenses, the taxes, the insurance, the exterior maintenance.
Yeah, which is simple, but it leaves the landlord highly exposed to inflationary risk.
How so?
Well, think about it. If property taxes spike in year 2 of a 5-year gross lease, or if insurance premiums surge after, say, a hurricane, the landlord absorbs that cost entirely. The NOI shrinks because the rent remains static.
Oh, wow. Yeah, that's dangerous.
It is. That's why the retail sector frequently uses percentage leases.
Oh, right, where they take a cut of the sales.
Exactly. A retail tenant pays a lower base rent plus a percentage of their gross sales revenue. So if a boutique in a shopping center has a massive holiday season, the landlord shares directly in that upside.
That's smart. But the ultimate goal for passive commercial income always seems to be the triple net lease, right? The NN.
Oh, absolutely. The holy grail.
Right, where the tenant covers the base rent, plus the property taxes, the building insurance, and the maintenance costs.
Yep, all of it.
But I have to admit, I've always had some confusion here. If a triple net lease pushes all of those heavy, unpredictable expenses onto the tenant, why would any business ever agree to that structure? Like, what's their incentive to take on the landlord's burden?
Well, it comes down to control and location permanence. Think about a national corporate tenant like a major pharmacy chain or a fast food franchise. They need uniformity across thousands of locations.
Right, the brand standard.
Exactly. They want absolute control over the aesthetics, the parking lot maintenance, the building repairs. They do not want to wait around for a local landlord to approve a roof repair.
That makes total sense.
Right, so in exchange for taking on the operating expenses, they negotiate a significantly lower base rent and they secure a prime location for like 15 or 20 years. For the landlord, it transforms real estate into something resembling a corporate bond.
Okay, but let me push back on a logical assumption here regarding these metrics.
Sure, go ahead.
If the cap rate measures the return on investment and a triple net lease provides a lower base rent, shouldn't an investor simply chase the highest cap rate property available on the market? Like, if I see a strip mall offering a 10% cap rate, shouldn't I logically grab that over a pharmacy offering a 5% cap rate every single time?
You'd think so, but no. The market prices risk directly into the cap rate. A 10% cap rate usually hides a looming disaster.
Wait, really?
Oh, yeah. It indicates that the broader market is demanding a massive premium to take on the hazard of that specific asset. When you do due diligence on a 10% cap rate property, you'll often find that it's in a decaying economic zone, or the roof needs a total replacement, or the anchor tenant is actively filing for bankruptcy.
So the high yield is essentially hazard pay.
Precisely, hazard pay, whereas the lower cap rate on the pharmacy reflects safety. A 5% cap rate on a triple net lease with a blue-chip corporate guarantor offers a lower immediate yield, sure, but it guarantees highly predictable, stress-free cash flow for a decade.
Right, you aren't getting midnight phone calls about a broken HVAC system.
Exactly. And the rent check just clears automatically. You're always balancing risk against reward. But you have to remember, even with the security of a triple net lease, acquiring commercial real estate requires deploying millions of dollars in leverage. And the way you structure that debt can actually introduce more risk than the physical property itself.
Yeah, let's transition to that. Because financing a multi-million-dollar acquisition is really where this stuff gets highly technical. You have to fund the deal without exposing yourself to total ruin if the macroeconomic environment suddenly shifts.
Right.
Traditional bank loans are sort of the baseline, right? They're predictable, they offer decent rates, but they are rigid. They require extensive underwriting and take months to close. But Tait contrasts these with CMBS loans.
Yeah, commercial mortgage-backed securities. They behave very differently than traditional bank debt. Wall Street banks pool commercial mortgages together, slice them into tranches based on risk, and sell them as bonds to global investors.
Like in the residential market before 2008.
Exactly the same concept. And because the risk is dispersed globally, CMBS loans often offer higher loan amounts and non-recourse terms.
Non-recourse meaning what exactly?
It means the lender can generally only seize the specific property if you default. They cannot legally come after your personal bank accounts or your primary residence.
Well, it sounds ideal.
It does, until you look at how a CMBS loan behaves during a market crash.
Right?
Yeah. With a local bank loan, if your primary tenant leaves and you need a temporary reprieve on payments, you can sit down with your loan officer and negotiate a modification. With a CMBS loan, your debt has been securitized and sold to pension funds in Europe and Asia.
There is no loan officer to call.
Zero. You deal with a master servicer whose only legal obligation is to extract the maximum value for the bondholders. The default process is mechanical, rigid, and totally unforgiving.
That is terrifying.
It is. And the rigidity of both traditional and CMBS lending creates a vacuum in the market for speed. If an investor identifies an undervalued property, but the seller demands a closing in like 14 days, traditional underwriting will just fail.
And that's where bridge loans come in.
Exactly. A bridge loan is a short-term, high-interest lifeline designed to secure a time-sensitive asset quickly. You acquire the property with a bridge loan, stabilize the asset, and then you take your time arranging cheaper, permanent financing to replace it.
But the creative financing mechanism that stands out the most to me in Tait's book is mezzanine financing.
Oh, yeah. That's a fascinating one.
The way I conceptualize it is through a structural metaphor. Like, imagine the capital stack of a deal as a literal building.
Okay, I like this.
The penthouse suite represents the senior bank debt, right? They have the safest position, and they get paid out first. The ground floor represents your personal equity. If a flood happens, the ground floor gets wiped out immediately. So mezzanine debt is the middle floor.
That is a perfect analogy. It sits subordinate to the senior bank loan, but senior to your personal equity.
Right, and you use it to bridge a funding gap without diluting your overall ownership percentage by bringing in more equity partners. But it comes with a severe mechanism attached. It's like a convertible vehicle.
How do you mean?
Well, mezzanine debt isn't secured by the physical real estate. It's secured by a pledge of your equity interest in the entity that owns the real estate. So if the project stalls and you default, the mezzanine lender doesn't have to go through a lengthy property foreclosure.
Nope, they definitely do not.
They just execute the pledge, convert that debt into equity, and become the new owners of the property, wiping you out completely.
Poof, gone. And this structural danger really underscores Tait's central thesis on financing, which is that over-leveraging is the primary killer of commercial portfolios. When your debt service consumes too much of your net operating income, a single unexpected vacancy will sink the entire operation.
Right. So how does Tait recommend mitigating that?
He recommends maintaining a strict loan-to-value ratio, or LTV, below 70%. So if you acquire a $10 million property, you carry no more than $7 million in debt.
So you're maintaining a 30% equity cushion to absorb market shocks.
Exactly. And you also have to conduct aggressive due diligence before the purchase to uncover hidden liabilities. Tait mandates environmental site assessments, or ESAs.
Yeah, the ESAs. You start with the phase one, right, which is
Right.
basically a deep historical review of the property to see if it was ever a gas station, a dry cleaner, an industrial chemical site, that kind of thing.
Right. And if the phase one reveals potential issues, you have to move to a phase two ESA, which involves physically drilling into the earth to test the soil and groundwater.
And what happens if you just skip that step?
If you bypass it, purchase an industrial warehouse, and later discover the soil is contaminated with toxic runoff, the Environmental Protection Agency holds the current owner strictly liable for the remediation.
Even if you didn't cause the pollution.
Even if you had nothing to do with it, the cleanup costs can run into the millions, instantly obliterating your entire investment.
Wow. So risk mitigation also has to extend to your financial models. Like you have to stress test your assumptions. You can't just project a smooth upward trajectory of 3% annual rent growth forever.
No, you have to run the mathematics to see what happens to your cash flow if interest rates spike by 200 basis points when you have to refinance, or if your occupancy rate unexpectedly drops to 80%. You must verify that the property can still cover its debt service in a worst-case scenario, and always hold 6 months of operating expenses in reserve.
Okay, so let's assume the due diligence is flawless, the financing is secured safely, and the property is generating a robust net operating income. Making the money is really only the first half of the battle. Protecting that income from taxation is the second.
Oh, absolutely. And the commercial real estate sector benefits from some of the most aggressive tax shields in the global economy.
The foundational shield being depreciation, right?
Yes. The IRS acknowledges that physical structures degrade over time, so they allow commercial property owners to deduct the cost of the building itself, excluding the value of the land underneath it, obviously over a 39-year useful life.
And that's a non-cash deduction.
Exactly. You aren't actually writing a check for that depreciation, but you get to subtract that amount from your taxable income every single year.
But waiting 39 years to fully realize those tax benefits seems horribly inefficient.
It is. Which is why Tait introduces cost segregation. It's a strategy that leverages the time value of money. Saving $50,000 in taxes today is mathematically vastly more valuable than saving $50,000 spread out over 4 decades, because capital saved today can be immediately reinvested to generate additional yield.
Right. So to execute a cost segregation study, you hire a specialized engineering firm to audit the property, right?
Yep.
And they break the building down into its individual components. So instead of depreciating the entire structure over 39 years, they identify the carpeting, the specialized HVAC units, the security systems, the parking lot paving, and they reclassify those components into 5, 7, or 15-year depreciation schedules.
Exactly. And by accelerating the depreciation of those specific assets, you front-load massive tax deductions into the first few years of ownership. This creates significant paper losses that legally shelter your actual physical cash flow from income taxes. It just supercharges your upfront liquidity.
That is amazing.
Mm-hmm.
But those benefits only apply while you hold the asset. When you eventually sell the property, you face capital gains taxes, and the IRS will recapture that depreciation, won't they?
They will try. But this is where the 1031 exchange comes into play. Under Section 31 of the tax code, if you sell a commercial property and reinvest the proceeds into a new, quote-unquote, like-kind property, you defer all capital gains taxes.
Wait. So with a 1031 exchange, can you essentially kick the tax can down the road indefinitely as long as you keep trading up for bigger properties?
You absolutely can. That is the precise mathematical mechanism used to build generational wealth in the real estate industry. You're utilizing tax-deferred capital to acquire exponentially larger income streams and compounding your growth over decades.
But there's a catch, isn't there?
Oh, definitely. The regulatory timelines are unforgiving. From the moment you close the sale on your original property, you have exactly 45 days to formally identify potential replacement properties. And then you must successfully close on one of those within 180 days of the original sale.
And if you miss it?
If you miss either deadline by a single day, the transaction is disqualified and the entire tax bill becomes immediately payable.
Wow. So the pressure of that 45-day window must force a lot of investors to buy suboptimal properties just to save the tax benefit.
It does. It's a very dangerous game if you aren't prepared. But alongside the 1031 exchange, Tait details opportunity zones, which operate on a completely different timeline and with a different strategic intent.
Right. Opportunity zones require you to invest your capital gains into specific, government-designated, underdeveloped geographic areas. You get an initial deferral on your taxes, but the true power of the program triggers at the 10-year mark, doesn't it?
It does. If you hold that new investment in the opportunity zone for a full decade, the capital gains taxes on the appreciation of that new asset are permanently eliminated.
Not deferred.
Not deferred indefinitely, eliminated entirely.
That's incredible.
It is, and it reveals the fundamental philosophy of the tax code. You know, these mechanisms aren't accidental loopholes exploited by accountants. They are intentional levers utilized by the government to direct private capital toward public interests.
Because the government lacks the resources to revitalize every neglected neighborhood themselves.
Exactly. Therefore, they offer to completely wipe out your future tax burden in exchange for you taking the financial risk to build infrastructure in an underserved community for a decade. It perfectly aligns private profit motives with public economic development.
That makes perfect sense. So once you've mastered acquiring the asset, structuring the debt, and shielding the income, we enter the final phase of Tait's lifecycle strategic growth and asset disposal. Scaling a single win into an empire.
Right, and scaling a single successful property into a resilient portfolio requires deliberate diversification. Tait advises expanding both geographically and across property types to insulate your NOI from localized shocks.
Like, if your entire portfolio consists of urban office buildings in a single city, a macroeconomic shift toward remote work is going to devastate your cash flow simultaneously across all your assets.
Exactly. However, if you balance those urban office buildings with suburban industrial warehouses and grocery-anchored retail centers, you create a hedge. When the office sector contracts, e-commerce logistics might be booming, keeping your warehouses at full capacity and driving your overall yield.
And as you scale, you also unlock economies of scale. You can centralize your property management teams, negotiate bulk service contracts for landscaping, and just systematically lower your baseline operating expenses.
Precisely. But the most counterintuitive discipline in this whole life cycle is asset disposal.
Selling.
Yes. Many investors fall in love with a high-performing property and view selling as a failure to hold. But Tait frames selling as a core professional competency. A successful exit validates your original underwriting.
I look at managing a commercial portfolio the same way a general manager runs a professional sports franchise.
Oh, I like that.
Yet you cannot afford to get overly emotionally attached to a star player who is peaking. Sometimes the most strategic move you can make is to trade your best performing asset while its market value is at an absolute premium. You trade that asset to acquire draft capital, which in this case is cash liquidity, so you can invest in the next generation of undervalued, high-growth superstars.
That framework perfectly counters the danger of what Tait calls silent value erosion.
Silent value erosion, what is that?
It's an insidious threat because it compounds invisibly. It occurs when you hold an asset too long without injecting fresh capital into it. The physical property ages, the roof nears the end of its warranty, and the neighborhood demographics shift as new commercial developments open across town.
And the mathematics of that erosion are terrifying. If your operating expenses rise by just 2% a year due to failing HVAC systems and rising insurance, while your rental income stagnates because the building looks dated, you aren't just losing monthly cash flow, you are actively destroying the terminal sale value of the asset.
because the value of a commercial property is directly derived from its net operating income. If your NOI shrinks, the subsequent buyer will apply the market cap rate to that diminished income, resulting in a drastically lower purchase price.
Plus, institutional buyers will demand a massive discount to account for all that deferred maintenance they'll have to fix.
Exactly. You are essentially handing your embedded equity over to the next buyer. Therefore, the process of selling a property begins years before you formally list it on the open market.
You have to prepare the asset to be scrutinized.
Right. Buyers pay a massive premium for absolute transparency and stability. If you go to market with pristine financial statements, a modernized building with zero deferred maintenance, and 5-year leases locked in with strong corporate tenants, you control the negotiation.
But if you're forced to sell in a panic because you're over-leveraged and drowning in repair costs, the market will instantly sense that distress and they will strip your equity to the bone.
They absolutely will. So the overarching lesson from Willem Tait is really that commercial real estate requires an entirely different operational mindset. You begin by mathematically validating the income stream through net operating income and cap rates.
You transfer inflationary risk utilizing triple net leases.
Right. You mitigate catastrophic downside through disciplined loan-to-value ratios and by truly understanding the rigid mechanics of CMBS and mezzanine debt.
And then you accelerate your liquidity utilizing cost segregation and permanently shield your wealth using opportunity zones and 1031 exchanges.
Exactly. It's a repeatable, data-driven methodology.
And it really completely changes how you view the physical infrastructure of the world around you.
Mm.
Think about the physical spaces you interacted with today. The local coffee shop where you bought your espresso, the office park you drove past, the massive million-square-foot logistics warehouse that shipped your latest online order.
They aren't just buildings.
No. Behind every single brick, steel beam, and pane of glass is a highly calculated high-stakes web of leveraged capital, structural debt, and aggressive tax strategy. What if, the next time you walk into a commercial building, instead of just seeing walls and doors, you look past the drywall and start seeing the hidden matrix of cash flow, risk, and opportunity? Food for thought for you today.
It really changes your perspective.
It definitely does. Well, that wraps up our deep dive for today. Thanks for joining us.